The experts have spoken. The federal budget is inflationary and won't help the push to cut interest rates. Wages growth slows sharply, and meme stocks keep running as echoes of 2021 are heard in markets. Welcome to Fear and Greed, daily business news for people who make their own decisions. It is Thursday, the 16th of May, 2024. I'm Michael Thompson, and good morning, Sean Aylmer.
Good morning, Michael.
Sean, after the show, you have a great interview today. I know they're all great, but this one is even greater. You're speaking with Chris Breike, founder and CEO of online investment advisor StockSpot. Chris is great, but it's what he's talking about that's fascinating.
Meme stocks. We talk about why the craze of 2021 is back in 2024. We've seen a couple of well-known meme stocks, AMC and GameStop, surge over the past couple of days. We ask him why they're called meme stocks to begin with and why they're surging. And what about this roaring kitty fella? Yeah. We ask him all about that too. It's a great chat.
Yeah, it really is. If you have been at all confused over the meme stock kind of craze, this is the interview to listen to, because Chris goes through it in chapter and verse and just explains it all. So it is a great way to get your head around that whole situation. It is coming up after the show, so stick around for that one. The main story this morning, though, Sean, the day after the budget, it really proved to be a day of debate, didn't it, about the inflationary impact of the federal treasurer's spending and an unlikely split between big business and the opposition.
Let's start with the economy. Is the budget inflationary or not? That was the big question. There's a surplus, which suggests it's not, but that isn't as big as it could have been. So maybe it is. The Business Council of Australia pointed out that new spending initiatives will put $24 billion into the economy over the next 4 years, and federal outlays will hit 26.7% of GDP, bigger than any time since 1987. The Business Council said more could be done in terms of savings from areas such as the National Disability Insurance Scheme. They came down on the side of, yes, it is inflationary. The Australian Chamber of Commerce and Industry said there was little sign of budget repair on Tuesday night, while AI Group boss Ines Willix said while $300 rebates on energy was good, it does all disappear the following year and suddenly you get these price pressures again. Ratings agency S&P affirmed Australia's AAA rating post the budget. It said that it was mildly inflationary, and some market economists have warned the energy rebates, lower student debt and housing assistance will put extra cash into people's pockets. The argument being a rebate doesn't put cash into their pockets, but they're basically saying it will put cash into their pockets, adding to inflationary pressures. The Reserve Bank could be forced to hold the cash rate at 4.35% well into next year. That's how the argument goes among some of those market economists. The government basically says the opposite. It says the rebates will actually subtract somewhere between 0.5% and 0.75 percentage points from headline inflation in the short term. That's what the government says, but I think the consensus is that the budget probably is a bit inflationary.
How is there so much kind of variation in these viewpoints? Because on one hand, John, you've got obviously Federal Treasury saying that kind of the modelling suggests that perhaps inflation could come back within the target range by the end of this year. And then you have all of these economists saying, well, actually, no, look, it is actually mildly inflationary and it might be blown out till next year.
The nub of it is that it's a rebate, not a cash in hand. Well, there's two parts to it. That's the first part. The second part is just the mechanical calculation of CPI, which includes energy, rents, stuff like that. Mm-hmm. Because people are paying less because they're getting a rebate, that will necessarily fall. So that mechanical part is why Treasury is saying, well, everyone's getting $75 off a quarter. Therefore, you're going to have the energy costs will be lower. Therefore, the CPI will come back a bit. That's that part of it.
Okay.
Whether or not it's inflationary is all about whether people spend that $300 somewhere else or whether they just figure, oh, look, it's a rebate. It's not actually extra money.
So there's a great deal of forecasting around human behaviour, which is often a very difficult thing to actually predict.
Yeah. I mean, that's what economics is, though. It's basically trying to put numbers around human behaviour.
Oh. I think for the very first time, I just got excited about economics, Sean. Oh, here we go. A little bit of a shiver went through me just then. That could have been horror. The miners were happy, though, yesterday. They got plenty of incentives to invest in critical minerals.
Yeah, about $13.7 billion in production tax credits, though they still have to pass Parliament. Now, they might struggle because the opposition said it won't support billions of dollars of handouts to billionaires. That pretty much pits the coalition against the mining industry, which isn't something that happens too often. The production tax credits for the critical minerals sector are modelled on assistance available in Europe and the US. And the government and members of the critical minerals industry says it's a way for Australia to become a power in the global energy transition. Now, the miners most likely to benefit are producers of lithium primarily, some rare earths, potentially nickel, although that market ain't so good at the moment. The $6.7 billion tax incentive for hydrogen was also welcomed by the industry, though experts warned that it needs to be very simple to apply. The incentives should certainly boost interest in the nascent hydrogen sector. The wrap of the budget, Michael, is that some of these critical minerals players are very happy with what's going on. It is mildly inflationary in this first year, very inflationary in following years. And we probably will put this one to bed and not talk much about the budget for another year.
Though if you haven't quite had your fill of budget talk, you can always go back and have another listen to Stephen Koukoulis's analysis yesterday morning on fear and greed.
Oh, you can. He kind of put it as not a meddling budget, that's unfair. A middle-ranked budget is how Stephen put it, but it's definitely worth listening to why he ranks it that way.
Yeah, indeed. All right, turning to local markets now. How did they perform yesterday?
The S&P ASX 200 closed up 0.4% to 7,754 points, led higher by the materials sector and healthcare stocks, while industrials lagged. BHP led the market higher, up 2.2%. Tell you why in a moment. CSL was up 1.2%. Both Rio Tinto and Fortescue Metals rose around 1%. Telstra did pretty well, up about 0.5%. The banks weren't so good, with ANZ, Westpac and National Australia Bank all ending lower. So too Transurban, Macquarie Group, Woodside Energy and James Hardie Industries. In corporate news, commercial radio and regional television company Southern Cross Austereo has rejected ARN Media's bid for the company. Now, that's the revised bid after the private equity group Anchorage Capital pulled out. And the Australian agricultural company's share price dropped 2% after it announced a full-year loss on the back of a challenging 12 months and lower cattle prices.
So, one more quick question about markets. The day after the budget, there's so much discussion about how the Tuesday night might affect different sectors. Are there kind of individual winners and losers among the stocks?
Yes. Now, we're not an investing podcast, so go and find your financial planner to answer this question. But based on what investment analysts are saying, one sector considered a winner from all the cost of living initiatives is the consumer discretionary stocks, especially those who cater to lower socioeconomic groups, Domino's, Super Retail Group, Collins Foods, which owns KFC. There's more money for housing investment. That should help companies that make homes or manufacture products for homes. Think Brickworks, Reece, those sorts of companies. Then there are others that could be hurt. The doubling of the visa application fee for international students could hurt IDP education, according to UBS. So certainly there are winners and losers, but go and see your financial advisor about that one. I mentioned IDP education then. It's something really interesting. So you would think post-budget, it may not do so well. Its share price was up more than 7% yesterday, which was the best of the top 200. It, along with marine and offshore service company MMA Offshore, Fleet Management and Leasing Group SG Fleet, Gold and Copper Explorer WA1 Resources, and Buy Now Pay Later Group Zip, were told they're going to be included in the MSCI Global Small Cap Index. This takes a bit of explaining. Michael, stay with me here.
That's always rather ominous when you say that something's going to take a bit of explaining. Go on. I'm braced for it, Sean. Go for it.
The MSCI Global Small Cap Index includes about 4,100 companies from 23 developed markets. It's the benchmark for small company indices. So if you buy an ETF, a global small cap ETF, it's likely to be somehow linked to the MSCI Global Small Cap Index. They might be competing against it. They may actually just buy stocks that are in that MSCI Global Small Cap Index. Suddenly, IDP Education and MMA Offshore and SG Fleet, WA1 Resources and Zipco all become part of this MSCI index, so people are going to demand their shares. Hence, their share price should actually rise. The flip side is some other ASX-listed companies have been thrown out, including Pro Medicus, Australian Clinical Labs and Tyro Payments. The upshot of all that, right, is it's good news for some of those companies like IDP Education because they're part of the MSCI Global Small Cap Index.
All right, Sean, what's happening in international markets?
Oil prices have risen over the past 24 hours after a report showed lower stockpiles in the US. Brent crude was heading back towards $83 a barrel overnight. Gold's up a touch, though markets were fairly quiet ahead of US consumer inflation figures. Over the past 48 hours, US Federal Reserve Chair Jerome Powell has suggested that people need to be patient and let interest rates do their work. The forecast budget surplus from Tuesday night here locally has also helped the Aussie dollar. It's trading around 66.5 US cents.
There is a lot going on. We'll be back in a moment with the rest of the day's business news. Sean, wages growth, a critical part of the inflation puzzle, slowed during the March quarter to a pace last seen more than a year ago.
The 0.8% increase in salaries in the 3 months to the end of March was the slowest pace of growth since December 2022 and below market expectations. The previous 3 quarters, wages growth was at least 1%. So this is quite a drop back. For the year, wages grew by 4.1%. Now, if you delve into the Bureau of Statistics numbers a little deeper, the March quarter was the first time private sector wages growth has slowed since 2020. It came in at 0.8%. The public sector wages growth was 0.5%. Why do we care about all these numbers, Michael? I can see those eyes of yours. It's like, yes, yeah, but why?
Why?
Who cares?
Why? You know me well. Why, Sean? Why?
Most of us want to get paid more. That's one reason. But perhaps more importantly, wages are a large share of a company's costs. If they rise, then the company's more likely to put up prices, which of course flows through to overall inflation. So slowing wages growth is actually good news, at least for inflation.
Sean, BHP Chief Executive Mike Henry has jumped on Anglo American's plans to demerge its platinum and diamond businesses, saying it's a variant of the $64 billion takeover proposal from the big Australian.
Yes, this is starting to heat up. Anglo unveiled a new strategy to investors 36 hours ago, which involved selling or shutting all the company's assets except those producing copper, iron ore, and crop nutrients. It will sell its interests in platinum and diamonds, and boss Duncan Wanblad said the sale of the assets would be more difficult if linked to a takeover. The bad news for Anglo shareholders, but maybe not for BHP, is that the announcement didn't go down well, and Anglo's share price fell 3% to £26.12. The implied price of BHP's latest offer is £27.53. For his part, Mr. Henry said the plan of Anglo management validated BHP's proposal, which is very similar, except of course that BHP takes control of the assets. Mr. Henry also said he would have preferred private discussions with the Anglo board, but alas, it leaked to the media. He said a formal bid won't be delivered by the May 22 deadline unless Anglo comes to the negotiating table. A bit of a threat there.
You did a really good explainer of all of this in yesterday's newsletter, I thought, Sean, which was very well received, I've got to say. And we've had some terrific feedback about the Fear and Greed newsletter. It comes out every Wednesday morning, mid-morning, and we get your unadulterated thoughts on a whole bunch of topics.
I prefer unleashed, but unadulterated is good.
Yes. Or about all of the big kind of business news stories of the week. Head along to fearandgreed.com.au to pop your email address in. It's a bit late, obviously, for this week, but next week you'll be in super early to get next Wednesday's newsletter. And who doesn't like being super early? Now, CSR's aluminium operations have fallen to an annual loss of $29 million because of high energy costs, posing a bit of a challenge for French giant Saint-Gobain, which is poised to become CSR's new owner.
Saint-Gobain is undertaking a $4.3 billion buyout of CSR. CSR has a 25% stake in the Tomago aluminium smelter in New South Wales, which has been a drag on the overall results for the building products company for decades, according to the Fin Review. Last year, electricity costs didn't help much either. CSR, which makes gyprock plasterboard, PGH bricks and pavers, ammonia roof tiles, Hebel lightweight building blocks and Bradford insulation, reported a 6% rise in net profit after tax for the 12 months ending March 31. Shareholders will vote on the Saint-Gobain $9 share offer next month. CSR's shares yesterday were flat. They're trading just under that offer price.
From today, Sean, all newly minted coins will include King Charles III's effigy, having been already added to the 5 cent, $1 and $2 coins last year. Now it's going to be all of them.
Yes, it's the first time in 59 years that the Royal Australian Mint has changed the monarch on its full suite of coins. The Mint said it has taken 2 months to transition fully to King Charles III. The first person to get a foolproof set will, in fact, be the King himself. Well, it's going to be sent to him first. Don't know whether he'll be the first one to actually open it. A foolproof set apparently contains the highest quality coins possible, made from a high-grade metal in a sterile environment, and is pressed 4 times under 110 tons of pressure. A full set costs about $150. That's one for the collectors. There's a more standard version, which sets you back about $40. Michael, this story sent me on a bit of a goose chase about coins because I never use coins, or you use them as tips, but mostly I don't know what I do with them.
Oh, go on.
Did you know the Mint can produce up to 2 million coins each day, and each coin stays in circulation for about 30 years? Isn't that amazing?
That is actually amazing.
The 1930 Australian penny is one of the rarest and most valuable coins. There also are $5 coins, which I didn't realise. They were produced in 2013. They're either dome-shaped or triangular, depicting Parliament House and the night sky. I think they were actually 25 years after the new Parliament House was opened. So they're actually $5 coins. They're collector's items. You're not going to see them around the place. Fascinating. The world of coins.
In international news, shares in video game retailer GameStop and cinema group AMC Entertainment surged for a second consecutive session, extending a meme stock rally that was sparked this week by the re-emergence of popular day trader Roaring Kitty.
Roaring Kitty. GameStop and AMC rose 60% and 32% yesterday morning, building on the 73 and 77% gains the previous day. Trading in GameStop was briefly halted for volatility 3 times in the first 20 minutes of trading. Both stocks had pulled back from highs hit earlier in the day, losing some momentum in afternoon trading. The moves come after trader Keith Gill, i.e. Roaring Kitty, appeared to resurface on Sunday after a 3-year hiatus from social media site X. Gill was at the heart of a rally driven by an army of retail traders during the pandemic. Retail traders piled back into many of the meme stocks, including GameStop and AMC, after that post over the weekend.
What would your name be if he's Roaring Kitty? Like squeaking catfish or something.
Like Passive Pound or something like that. I don't know.
Yep, Bleating Lamb. I don't know, something like that.
What would yours be? Like Awkward Aardvark?
Tough Nugget or something like that.
Tough Nugget.
Yeah, that's me. The Nug. Beijing is considering buying millions of unsold homes from across the country in an effort to kickstart the all-important property market in China.
How's this for an idea? It would certainly be ambitious. And the idea is to clear some of the excess housing stock. Smaller programs across the country have been tried previously and they're more or less worked, but this one's much more ambitious, according to Bloomberg. Local state-owned enterprises would be asked to help purchase unsold homes from distressed developers at steep discounts using loans provided by state banks. Many of the properties would then be converted into affordable housing. Officials are still debating details of the plan, its feasibility. If it does take off, it could be months before it's actually finalised. And of course, it needs China's leaders to decide to go ahead.
All right, up next is the Fear and Greed Daily Interview. You are talking today with Chris Breike, founder and CEO of online investment advisors StockSpot.
All about those meme stocks, all about AMC, all about GameStop, what they're about, how they work, why they're kind of ridiculous. Well, he doesn't say that, so I shouldn't put words into Chris's mouth. But if you're interested in meme stocks and you want to know all about it, listen to Chris.
Yeah, it is a great place to start. It's up next in the Fear and Greed playlist on your podcast platform or at fearandgreed.com.au. And yesterday was Wednesday, and I missed this because we were so excited about the budget and all that. But I forgot to mention, how do they afford that? There was a new episode came out yesterday.
What's it about?
Well, it's all about people who are asset rich but cash poor. So I think perhaps a lot of kind of retirees, pensioners, things that might own their own home, and some of those options that are out there for unlocking value within your home, reverse mortgages and things like that. And so we talk about the pros and cons, the risks that are involved there, and also some other ways to do that, to actually access some of that capital. It's a really interesting topic. It's relevant to quite a particular part of the community. But if it's not for you, it might be for your parents or someone that you know. So it's well worth a listen. Check that one out. You can find How Do They Afford That wherever you listen to podcasts. I'll put a link in today's show notes as well. Thank you very much, Sean.
Thank you, Michael.
It is Thursday, the 16th of May, 2024. Make sure you're following the podcast and please join us online on LinkedIn, Instagram, X, TikTok and Facebook. I'm Michael Thompson and that was Fear and Greed. Have a great day.